The Federal Reserve controls your money, your mortgage, and what your paycheck is worth. It also told America inflation was transitory, right before prices hit a 40-year high. Now Congress is asking whether the Fed itself should be rebuilt.
Well, thank you very much, and thanks again to our witnesses. Fabulous testimony, great insights, and I think all of you all have made a very powerful and persuasive case for retaining the federated system and the diversity of thought, the independence that it brings, the operational effectiveness, and the public trust that it creates. Great. However, as you all know, there are critics of the Federal Reserve. In most recent history, a good example of critics pointing out that the Fed made a major mistake in 2021, underestimating how persistent inflation would become by describing it as transitory, waiting too long to begin raising interest rates and continuing quantitative easing, purchasing $120 billion per month in Treasury and MBS all the way through March of 2022, when CPI was almost already at 9%. And because of that, I think the critics and members of Congress, we said, no, wait a minute. The Fed delayed tightening, and that ultimately forced the Fed to move much more aggressively in 2022. And we were actually sounding the alarm. I remember an oversight Humphrey Hawkins hearing with Chairman Powell, who I have great respect for, and we said, well, wait a minute. The Chambers of Commerce back in Kentucky are telling us everything's too expensive. And that was a year before tightening began. Was there a failure in the federated system? Why didn't that data get back to the Board of Governors sooner? And maybe you were sounding the alarm earlier than the FOMC was able to take action, and they just ignored you. Mr. Hoenig, can you speak to that?
Yes, and in my comments I said it's the best system. It's not perfect, but I will tell you this is where the role of dissent matters. And in other periods, for example, myself, where I may have had that kind of disagreement, at least I made that argument to the committee, and the committee then had to make a measured decision whether to take that and give more weight to it or not. And the fact that you have this decentralized system and you can bring these dissents forward doesn't make it necessarily perfect, or that you'll get the answer that you wanted as a minority dissenter, but it does bring greater debate to the system, and mistakes will be made. Hopefully, fewer mistakes than otherwise would be a mistake without the ability to have independent views voiced strongly in those meetings.
Well, quick follow-up for anyone. You've made the case for why the current system is a good system. I agree. But what doesn't work? What reforms should we consider in Congress to the Fed to improve effectiveness?
Sure. I'll make one quick comment on that. I do think that over time, there's always been a tension between the center and the reserve banks and that. And I think more and more there's a deferment to the chairman. Don't want to dissent unless you absolutely have to. That culture is, I think, weakening the system. I think the boundaries need to be clear. The board has oversight, reserve banks have independent views, and those views ought to be expressed and voted on without any kind of reservation. And I think that's something we need to think about for the future, a strong independent reserve bank system.
Well, first of all, Mr. Chairman, thank you for your hospitality in the great state of Oklahoma and for welcoming all of us here to celebrate in the middle of the country the federated system of the Federal Reserve and the very unique public-private hybrid approach to the third central bank of the United States. Let me start with you, Mr. Hoenig. Since its creation in 1913, of course, our country has experienced enormous changes and growth to the economy. Has the Federal Reserve System ever reapportioned what areas the country, each of the 12 banks, 12 reserve banks oversees and serves? And given shifts in population and geographic concentrations and even changes in the economy, I believe the 12 banks is a creature of the statute. Tell me about the history of reapportionment, and would it be wise to consider reapportionment given population shifts and where the geographic banks currently exist?
Well, as far as changing the boundaries. In that sense, it has gone on. In fact, the 10th district that we're in right now, the southern part of Oklahoma was in the Dallas district. That was moved to the Kansas City so that it was a full state. That happened again in Missouri for that, and other districts as well. As far as the location of the offices, the branches, and the head offices, they've been constant since they were first formed. I think you can change the boundaries and still get representation. I think the cost of moving headquarters would be very depth, and you would spend a lot of time and effort doing that. And I don't think the change would make improvement. It would merely make a change. And so I think keeping the boundaries, moving them as you need to is fine.
Is 12 the right number?
You know, what is the right number? The main thing is it is distributed across the country, whether it's 14 or 9. The most important thing is it has to be enough that is actually representing a broad base across the country by region. And I think 12 is a good number.
Mr. Kelly, my final question in the first round. Could you explain the benefits of having the 3 classes of directors that serve on the boards of directors of each regional reserve bank?
I think it really starts with the public-private nature of the whole system, where the banks, unique in the world, are actually owned by the member banks in the district. And so as one of the benefits of being a shareholder of the bank, you get to vote for representation on the board. So we have Class A directors, which are elected by the shareholders from among the community banks. I find it very, very insightful to have 3 bankers on our board, providing, again, on-the-ground insights. The shareholders of each bank also elect the 3 Class B directors, which are at large from the district. Once again, it's a very diverse group, and I think we all value and benefit from that. And then finally, I'm a Class C director, as I know you know, and we're appointed by the Board of Governors. So you have a nice mix of independent directors that come to the board from different sources and have different representation. And then the duties in terms of electing presidents and first vice presidents, we avoid a conflict of interest by excluding the A directors from those appointments. So I think it's new for me, but I think it's a very elegant solution. I think it works very well.
Witnesses, great hearing, great testimony, really educational. And I really want to thank my colleague from California's line of questioning, because that's really what I wanted to follow up on too, again, we should be constantly striving to improve upon a system that does work. And again, you all have made a great case for decentralization and a federated system. But let me make my final question to Mr. Kelly as Vice Chairman of a Reserve Bank of the Dallas Fed. What opportunities are there to make enhancements so that Mrs. George's concern is addressed, so that maybe we could elevate the status of that dissent, elevate the status of these decentralized reserve banks in the system, so that the Board of Governors don't overpower all of the incoming data in real time from the reserve banks. And so to that end, Mr. Kelly, what opportunities are there for reserve bank directors and even reserve bank branch directors? I say that as someone from Kentucky. We only have one presence of the Fed in Kentucky outside of Cleveland and St. Louis, and that's Louisville. We have a branch bank in Louisville. What opportunities are there for those branch directors to interact with each other, with the Reserve Bank presidents and the Board of Governors? And would there be utility in holding an annual conference where the entire leadership of the entire system are together, so that the Board of Governors and that all-important chairman can have access to all of these people in these branches and out in the country who are actually they're seeing the data and hearing from the participants in the real economy in real time?
Thank you very much for that question. I completely agree with what Esther described, the need for the independence. And so I do think that it starts with, first of all, a recognition that that's important. The boards have a duty. They have a duty of loyalty, care, good faith, and they need to recognize that that is an important thing to exercise, that independence. I completely agree with your point. It doesn't matter what the entity is, there needs to be a constant view of improvement. Learn from past mistakes and try to mitigate them and take advantage of opportunities. Chair Warsh has already made clear there are policies that he would like to review. I think boards welcome that. That perhaps would get back to your earlier question about why were these things missed, if you will. And so I think continuing to review policy is important. Just the opportunity to continue to improve the operations of the banks, make them more efficient, have better information quicker. There are plenty of opportunities to do all of those things, and we've got to strive very hard to do that. And Tom mentioned this earlier, the ability for 19 people to be able to speak up and speak their mind is critically important. So despite the fact that mistakes, it's a human endeavor, we're trying to predict the future, there will be mistakes. But if we don't allow that going forward, then we're almost guaranteed to make more mistakes in the future, because we'll allow ourselves to devolve into groupthink. The independence of the banks from the governors and among the banks, I think, is critically important. Finally, you said that getting together. There is a Council of Presidents that I think is very functional. There is also a Council of Chairs among the boards. I'm a member of that, so it's the 12 banks, the chair and the deputy chair, and there are absolutely opportunities for engagement at that level, and the chairs meet 3 times a year and engage with the Board of Governors. I think there's opportunities to improve that as well. So I completely agree with your urgings.
Thank you.
5 minutes.
Thanks again, Chairman, and thank you all. Earlier, we mentioned the Federal Reserve can just create money. They have a unique role in that sense. Everyone else can't, legally anyway. And one of the things that has changed about the Federal Reserve over time has been payments. Cash was king, and still is in a business sense, but literally most payments aren't made with cash. Checks and ACH have come along, and today we're working on faster payments, and FedNow was one of those things. But you look at stable coins and the future of money, really government involvement, private sector, bank settlement, credit cards, all these things have changed with payments. The enduring thing, though, is no government really gave anyone the right to transact. It predates government. Governments have become a bit nosy. They want to know everything about every transaction, just to keep us safe, of course. But that creates a bit of anxiety for a lot of the public because it essentially puts somebody else between you and your money. A lot of people tout that as a feature of things like central bank digital currency because they call it programmable money, and it'll give you these great powers with monetary policy, i.e. coercive behavior. Which is why people don't want it. They want the payments. So I guess maybe you could go through and say, where do you see the future of payments, and how's the Federal Reserve adapting to that?
Well, to your point, I think there are legitimate concerns about privacy and payments. It's not something that's outrageous. It is a legitimate concern. And as you develop, whether it's digital currency in the private sector, it still can be traced. So how are you going to do that? And that is an open question that I think is now being discussed in Congress in terms of the laws around stablecoin and around cryptocurrency and tokens. And I hope not to put it back on you, but I hope Congress defines the rules pretty clearly, because I don't think it's the Fed's business to be defining what the criteria should be. It's the Fed's business to follow what Congress has assigned them. And when you say, if you look at banking today, it is surrounded in regulations primarily to protect the public, and Congress developed those laws that then became regulations. So we need to think about it in advance as we apply it to not just the banking industry, but to stablecoin, if we're going to have that, to tokenization. It's there that we have to address it, not after it's approved and not after it's, have access to the master account and so forth. So it's a big deal, and I agree with you. It needs to be addressed carefully.
Yeah, so if you think about like the nature of technology, part of the things that people attribute to the collapse of Silicon Valley Bank was the fast flow of information, which led to quick withdrawals. And fractional reserve banking has that vulnerability. A stablecoin it doesn't, because it's not fractional; it's fully backed. So some people see that as more sound. But in that environment, maybe, Professor, what do you see out there with the future of payments?
Well, I think that there's always going to be a demand for anonymity in terms of financial payments, at least in some sectors, and that demand is going to be there unless it's legislated away. And I think that would be one thing that I could add.
Thank you. Thanks, Chairman, again for hosting and for everyone that helped put it together.
I thank the Chairman. Professor Keene, you and I had a discussion offline before this hearing started, and one of the things we spoke about was the potential disruption of AI. Mr. Kelly just mentioned it, but more, I think, focusing on the issue of water and energy. But I think that there's going to be a tremendous disruption, I think, in our economy and maybe even at the Fed because of AI. I like history, and I think of people talk about the issue of the computer and how that disrupted our economy. And I think you have to go back further and really look at industrialization. I think that was the great disruption, where you saw people coming from the farming communities to the large cities, the disruption that you had there. Would you comment a little bit about that? I'll get back to Mr. Kelly on the issue of the energy and water, but the disruption that AI might produce when we talk about data independence of the Fed and all these other things, because AI is going to have, I think, an immense impact on our economy, on the way we do things.
Well, AI presents the possibility of having a large productivity shock to the U.S. economy. It's going to expand the pie, and so we're going to expand GDP. That solves problems that exist out there. The concern is we are going to dislocate potentially entry-level labor. There is some concern that companies are no longer hiring entry-level labor right now, so these entry-level workers are our future CEOs. They're our future
When you say
executives.
entry-level, though, do you mean also white-collar entry-level jobs?
I'm talking about college graduates in particular.
Okay.
That's who I'm talking about.
Okay.
And so there's a concern about that. Now, the question is how is this going to evolve? I don't think there's a historical precedent. The best that you can go back to is, like you said, with the Industrial Revolution. But we need to be vigilant, and we need to watch this occur. I don't think we need to rush to do something, but we don't need to be waiting to respond. So I think it's watch very carefully and see how things develop.
Okay. Mr. Kelly, you were the first one, I believe, that mentioned AI, and you mentioned it within the context of you watch it very carefully with respect to water issues and energy issues, because those are the ones that are most salient at the moment. But what else do you see in AI that's coming to us?
Well, I'll start out with aviation analogy, just with the rate of change here. If from the Wright brothers until a man on the moon was 66 years. And we've all lived through, over recent decades, massive change. And I think indeed, this is probably going to be the biggest yet. It's here, and it's not coming. It is here. So The impact on the economy right now is outsized, so I think that is a concern. If it stops, the impact on markets, whether it's equity or debt, it is a massive undertaking that's taking place. What I hear from our district are these concerns. I don't know that that the board are.
But what about the issue of the independence? So, for example, right now, as you probably know, there's an issue, as there always has been, by the way, the independence of the Fed. We see it, I think, a little more theatrical maybe these days, but there's always been pressure on the Fed to not be independent, to drive the rates down. But how will this information that's going to be so massive, how will that affect the independence of the Fed in this system?
I don't necessarily see that as a challenge to the independence. I do see it, as we were discussing earlier, as it is a change. There's an opportunity for efficiencies, and I think whether it's the Fed or business or any other entity, we're going to have to embrace that change and make sensible changes and adapt. But I see that as a separate issue from independence. It is, again, serve the American people, do it in the most efficient way possible, manage the risk of change very, very carefully so we don't impair our mission. But I think the independence is important, and I think that should be retained.
5 minutes.
Thank you, Chairman. Thanks for putting this together, and thanks for everybody for participating in it. It's an honor to get to serve on this committee. And, constituents do talk about the Federal Reserve. Now, I won't say it's not going to make primetime news normally. But, when we talk about the structure, one of the things that people wonder, what did we create when we created the Federal Reserve? You talk about it's accountable, but one of the main ways anybody's accountable to Congress is the power of the purse. And the Fed was sort of created as an autonomous entity in a way. And you say independent, and people wonder, well, how independent? And so I'll recognize executive orders could be unconstitutional, as could laws for that matter. But as you guys go down, yes or no, do you believe that the Federal Reserve is accountable to comply with executive orders?
Well, I think, frankly, that the Federal Reserve was created by Congress and is accountable to Congress. Congress can change the laws, can change how it's funded, can change how presidents.
Right. I mean, we created the Department of Defense too. I mean,
right.
In 1947.
Right.
So, but they're clearly subject to executive orders.
Well,
are you guys subject to executive orders?
Well, we do have an executive order in terms of how bank supervision is carried out today. That I think is complied with. I think when Congress created the Federal Reserve, it created it to be independent of political influence.
With respect to monetary policy, yes, I'm not asking about monetary policy. Just, if the President of the United States issues an executive order that says, every bank examination shall include whatever, or in the case here, one of the executive orders that he issued was there will be no central bank digital currency. Through the structure, the federal government, Chairman Powell has said, well, we agree that Congress would have to authorize us to do a retail CBDC, but you're clearly working on a wholesale CBDC, which, from a lot of folks' perspective, it isn't much of a distinction. On the back end, it still does all the things that a central bank digital currency would do. It's just cosmetically different on the front end. But the President has said there'll be no central bank digital currency. So are the Federal Reserve banks still working on it, as an example?
I wouldn't argue. You've been there a lot longer than I have, Mr. Chairman. I'm the newest guy sitting up here. One question that I get when I'm back home and really around it, and I believe that affordability is a legitimate issue around the economy and around the country. And I can tell you that a lot of the things that we've done in Congress, whether it's road to housing, to try to increase housing supply, whether it's a lot of the reg reform to allow more energy to hopefully deal with that, notwithstanding some geopolitical events at the moment. that is probably the issue that I hear about the most. And it's certainly not something that happened overnight. Probably 4 years of a lot of spending right during and after COVID contributed greatly to that. But as the questions have actually come through in the conversation and the very thoughtful responses of our witnesses today, it got me thinking, what are things that the Fed could and should possibly do, and this is open to any of the four that want to take this question, when it comes to helping address on a macro level affordability?
I think that affordability is an issue around monetary policy and the discipline of monetary policy. So one of your issues around massive purchases of assets onto the Fed's balance sheet is what it did to asset values and affordability. Another is stable prices. If you do not have a disciplined monetary policy, you have price problems, inflationary problems, which is highly regressive. So to your point, the Fed has, as a system, a responsibility to pursue stable prices. When I say stable prices, I mean both inflationary and asset inflationary prices. If it fails to do that, then it made a mistake, and it needs to correct that. But that's the key. And the other part of it for the central banks, and central banks around the world, is to know what monetary policy can do successfully and what it cannot do. And it cannot solve every distributional problem in the United States or anywhere else.
Agreed.
I'll mention, we're talking about AI. Productivity shocks are disinflationary. So if we have a big productivity shock from artificial intelligence, that's going to lower firm cost. Firm costs are then eventually going to force them to lower their prices. That creates a disinflationary trend in the economy. So that's a possibility as something that would help.
I don't really have anything to add. It is a blunt tool. I would just reemphasize, the mandate for price stability, because inflation is insidious and it affects everybody. So there are byproducts, but more than anything else, I think price stability has to be pursued, and that ultimately, hopefully, you have breakthroughs with productivity. No doubt they will come, but in the meantime, we're not hitting our inflation target, and there just needs to be a maniacal focus on hitting that target.
Thank you, Mr. Chairman, and by the way, you're a great host having us here in Oklahoma. It's been a wonderful visit. I want to thank our witnesses as well. And like most central banks around the world, the Federal Reserve was intentionally designed as a decentralized system, as has been testified to previously, one that combines the national policy making with regional representatives. Congress recognized the economic conditions in New York may look different than those, for example, in my home state of North Carolina, or of course here in Oklahoma. The Federal Reserve System was designed to ensure that monetary policy and banking supervision would be informed not only by data coming out of Washington, but also experiences of businesses and consumers from around the country. That regional perspective is particularly important for states like my home state, and I would say probably most states outside of some of the major banking or policy areas. I can tell you economic conditions facing a manufacturer in rural western North Carolina, or a small business in eastern North Carolina, or a family in Charlotte can be very different than things viewed around the country. Mr. Hoenig, you've spent, of course, 2 decades as president of the Federal Reserve Bank of Kansas City and participated in interest rate deliberations through multiple economic cycles. How important is the regional reserve bank structure in ensuring that monetary policy reflects conditions across the entire country, rather than primarily the perspectives of Washington? Everybody sort of touched on this, but how have you seen that, and can you think of examples where that regional perspective probably helped the board take action that may have been better than if they just relied on, say, just what was coming out of Washington?
Well, I think there are many examples, but usually it's most apparent when there's a crisis. And whether it was a crisis of the agricultural crisis of the 70s and 80s, where this part of the country suffered very significantly relative to others, we at the Federal Reserve Bank of Kansas City and Dallas were very much aware of it and involved in it in terms of trying to find solutions. With the great financial crisis, in fact, as solutions were being pursued for liquidity for major corporations, major banks in this country, I was in those meetings in Washington, and one of the things I was able to do was point out that, I'm sorry, but the Midwest has some pretty large companies, pretty large banks. Let's make sure these policies or these programs that you're developing for liquidity purposes extend into the Midwest and into these. And had I not been at that table, I'm sure there would have been some coverage, but it would not have been anywhere near as detailed or anywhere as thorough as they were by having that input into the process. So those are just two examples, but you can see it in COVID. You could see it in the terrible periods of the 1980s, where the regional banks came forward and found solutions to problems that would have been much more devastating to that region had they not been done.
Well, thank you. And of course, I would submit one of the greatest strengths of the Fed is the ability to gather information from local businesses, banks, and community leaders. And
let's start with you, Dr. Hoenig, and thank you for sharing your insights with us again. Can you expand on your written testimony? Why should having a decentralized system like ours produce better monetary policy outcomes as opposed to a bank concentrated in Washington, D.C. or New York City?
Well,
we'll just cut to the chase.
No, thank you very much for that. I would tell you that the best way to describe it is I've sat on many FOMC meetings, and in part of that meeting, you have a go-around of each of the districts, each of the 12 districts. And through that, you learn about what is going on in the region. And as you go around the room, you kind of paint a picture of the U.S. economy on the ground. That is, you're not looking at aggregate data, looking backwards. You're looking at what's happening today, and it can vary very substantially among those districts. And by doing that, you have a better understanding of the economy as you discuss the issues and where the differences are. And from that, you can begin to say, well, what can bring a consensus towards a policy decision? Or even more importantly, if there are going to be differences and dissents, you understand where the dissent is coming from. So you really find yourself coming to a better conclusion about what the policy should be, whether you can agree or can't, and how you can form a policy that all can live with and is in the best interest of the country as a whole. And I don't think you can get that if you're all centered in Washington, looking at aggregate data, looking backwards.
Thank you. Professor Keene, in the amount of time I have left in this particular round, would you like to provide your thoughts on that as well? Why does proximity matter? How does it benefit future farmers and economists at OU and OSU when it comes to agricultural research in their backyard?
So I will go back to experience that I had when I was working on my PhD. I had the opportunity to, I was staying in Richmond, Virginia one summer for a few weeks and was able to go into the Richmond Fed after contacting some people there. And it's the opportunity to learn not only the data resources that are available, to have access to all the research tools, but the economists that are there allow for mentoring. They, help young economists that are just getting out learn how to really the system works and how to publish papers and how to conduct research. And it allows them to expand beyond their university. And having the idea of having a Federal Reserve district in different cities instead of having to go to Washington, it allows different students in areas throughout the country to be able to experience that, whether it be in St. Louis or in Richmond or any of the districts.
Thank you.
Let's break down a field hearing on a big, unusual question. Should Congress change how the Federal Reserve itself is built? 6 members questioned a panel led by Thomas Hoenig, a former president of the Kansas City Fed. The topics range from a past inflation mistake to the 12 regional banks, digital money, and how independent the Fed should be. 2 questions run through the whole hearing. First, Did the Fed get something important wrong, and what should follow from that? Second is its structure, the 12 regional banks and its independence from politics, a strength or a flaw. Reasonable people answered those differently, so let's separate the settled facts from the open debates. Here is the frame. Several members argued the Fed needs more accountability and less concentration in Washington and New York. The panel's main witness argued the decentralized structure is a feature worth keeping. Neither side is obviously right. The job of a fact check is to mark what's proven, what's hypothetical, and what's a genuine trade-off. Start with the sharpest and most concrete charge from Congressman Andy Barr. He went back to the Fed's inflation call during the pandemic. On this, the record is clear, and it favors Barr's premise. Fed Chair Jerome Powell publicly retired the word transitory at the end of November 2021. Inflation then climbed to about 9% by the middle of 2022, the highest in 4 decades, and the Fed did not start raising interest rates until March of 2020. And this is not a partisan reading. Former Fed Chair Ben Bernanke later said plainly that transitory was a mistake, and former Treasury Secretary Janet Yellen said she regrets using the word. So Barr's starting point is solid. The real argument is about what reform, if any, should follow from an error that the Fed itself has acknowledged. From there, Barr turned to the structure itself, the number and location of the regional Fed banks. Here's the fact behind the question. The Fed's 12 districts were set when the system was created in 1913, and the map reflects the economy of over a century ago. 2 of the banks sit in Missouri, while much of the fast-growing Mountain West and Southeast are folded into distant districts. Whether that map should be redrawn is a fair question with no settled answer. The witness pushed back, and his point deserves weight. Thomas Hoenig argued that the regional banks bring Main Street perspective into a system that would otherwise be dominated by Washington and New York. So this is a real trade-off, not a proven error, modernize the map, or protect the regional diversity it produces. Barr also pressed a panelist, Gary Kelly, on a subtler problem, how a big institution avoids groupthink. The context here is real. Formal dissents on the Fed's rate-setting committee are rare, and historically the regional bank presidents, including Hoenig himself years ago, have been the most frequent dissenters. So the reform argument is that structure should protect independent voices. That's a values question about good governance, not a factual dispute. Congressman Warren Davidson shifted to the future of money, a central bank digital currency, and privacy. Davidson's concern was about control, a digital dollar that a government could, in theory, monitor or restrict. This is where a fact check matters most, because 2 things get mixed up. The United States has not launched a central bank digital currency, and in early 2025, an executive order actually barred the government from creating one. And the Fed's instant payment system, FedNow, launched in 2023, is not a digital currency. It is just a faster way for banks to move existing dollars. So the privacy concern is worth debating, but it is about a hypothetical, not a current program. The honest framing, no digital dollar exists or is planned, and FedNow is a payment rail, not a surveillance tool. The time to write privacy rules is now, before any such currency is ever built. Ranking Member Juan Vargas widened the lens to something bigger than any one program, artificial intelligence and jobs. This was less a charge than a forward-looking worry, and a legitimate one. The Fed has a dual mandate, stable prices and maximum employment. If artificial intelligence reshapes the labor market quickly, that directly affects the employment half of the Fed's job. It's a reminder that structured debates sit on top of fast-moving real-world change. Davidson returned with the question at the heart of every Fed debate: how independent should it be? The legal picture is specific. The Fed is independent within the government, the president cannot direct interest rate decisions, and Fed governors have protection from being removed without cause. Reformers say that's too little accountability. Defenders warn that letting politics set interest rates is how countries get runaway inflation. That tension is the debate, and both concerns are real. Congressman Chuck Edwards brought it back to kitchen table reality, affordability, and asset prices. His point has strong support. After 2020, the Fed held rates near zero and bought trillions in bonds, and over the next few years, home prices rose roughly 40% nationally. Easy money helps borrowers, but it also lifts the price of assets like housing and stocks, which widens the gap between people who own them and people who don't. Congressman Tim Moore defended the regional banks from a practical angle, what they do in a crisis. There's a real record behind this. In the 2008 financial crisis, and again when Silicon Valley Bank failed in 2023, regional Fed banks provided local intelligence and emergency lending on the ground. That's a concrete argument for keeping regional strength, and it cuts against the idea that everything should run from Washington. Chairman Frank Lucas closed the strongest thread, the case for a decentralized Fed. Lucas framed the whole hearing as a choice about where power over money should sit. And here's the twist that ties it together. Hoenig, the witness defending the regional structure, has also argued for years that the Fed's wide discretion opened the door to policy mistakes and should be reined in. So even the structure's biggest defender wants guardrails. The debate isn't reform versus no reform, it's which reforms and where. So let's total it up, the way a fact check should. The transitory inflation miss is settled. The Fed got it wrong and has admitted it. Redrawing the century-old district map is an open debate. The digital currency fear is about something that doesn't exist and is currently banned, and Fed independence is a genuine trade-off, not a scandal. None of this tells you how to vote. You can want a leaner, more accountable Fed, or you can want to protect its independence and its regional reach. The narrow point is precision. A proven error, a 100-year-old map, and a currency that doesn't exist are three very different things, and they shouldn't be blurred into one. So where does it leave us? With a serious question, whether the Fed structure still fits the country, wrapped inside a hearing that mixed a real mistake with a few scare words. The structure debate deserves the spotlight. It just deserves it without the parts that don't hold up. Watch three things from here. Whether Congress actually moves to revisit the district map, whether the ban on a U.S. digital currency holds, and whether the Fed's independence survives the political pressure now aimed at it. Those answers will come on the record. That is our breakdown. Stay with us.